silver's just marginal to them. Therefore, if silver price doubles, it's not really that much of an incentive for them to produce more. If silver matched lead and copper, it could go to $200.
So I think the gold-silver ratio will continue to come down, meaning in silver's favor. We'll go from like 85 to 70. I'm looking at 70 as kind of a turning point, and then down to 60, perhaps 30, and maybe even to the historic classic monetary ratio of 15 or 16 to 1. And if that happens, the silver relative to gold will be like a fourfold increase relative to gold. In other words, it'll perform much. And I do believe that will happen, but I don't know.
Michaeloliver and David Morgan outline a scenario where silver's long-term potential vastly outpaces gold's. They explain that because silver is essentially a byproduct of base metal mining, even a doubling in price doesn't significantly motivate increased production. That supply rigidity, combined with rising monetary and industrial demand, sets the stage for a decisive upside move. The key lies in the gold-to-silver ratio, currently hovering around 85 to 1. Both analysts expect that ratio to contract steadily, first towards 70, then 60, and possibly even down to the historic 15 to 1 range seen when silver and gold were both used as money. Such a shift would represent a fourfold outperformance of silver relative to gold. As this revaluation unfolds, the undervalued nature of silver becomes impossible to ignore. Investors positioned early could see explosive gains as the ratio normalizes. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
All norms of technical analysis like RSI and so forth will be a total falsehood if you follow them. In other words, once you get silver up to a monthly RSI that's overbought, if you get out there, you're going to miss the move. Even back in, I think it was 79, you got monthly RSI above the what is the overbought level, stayed there for like 5 months. In other words, you should have bought the overbought level because it stayed there for 5 minutes, it exploded. In other words, all the norms get smashed. We have a situation in silver where, for some reason, and one reason may be the artificial suppression of the market by certain banks, maybe inclusion with central bank, I don't know, where it stayed in a 50-year range. You go back and look at copper or lead. We ran those charts a few weeks ago, go back to the 1970s, and you'll see that they were in a range, 1970s, 80s, 90s, into mid-2000, like 2005 or 6, where they were stuck in this orderly reality, up, down, up, down, up, down. And when they came out of it, literally in a few quarters, they quadrupled in price. These were different times. They weren't doing it together. Copper went up in like 2005, 6. Lead went up in 2007, so it wasn't the same driving force. But they quadrupled in price. And then since then, they've lived in a new zone of reality that's like 4 times the average price of that prior zone of reality. How come silver's still in the prior zone of reality? Look at gold. I mean, where was it in 1980? $850. Silver was 50. Okay, where was it in 2011? 1920. Where was silver? 50. Gold's 4,000. Where's silver now? 48? Okay. What's going on here? We know silver's in great demand by high technology. Solar panel production. Chinese are about 80% of that market. They need silver in the cells. And there's also AI demand for silver. Microscopic, but pervasive, okay? It's a great conductor. And we know for 5 years now, the new supply has not met demand. There's been a deficit 5 years in a row, supply-demand deficit. And we know that when silver price goes up, it doesn't induce necessarily more silver production. Why? Because most of silver production doesn't come from silver mines. It comes from base metal miners who are primarily motivated and focused on getting copper out of the ground or magnesium or whatever. And silver's just marginal to them. Therefore, if silver price doubles, it's not really that much of an incentive for them to produce more. If silver matched lead and copper, it could go to $200. Okay. Now, and also, if you go back and look at 1980 high at 50 or 2011 at 50 and factor in the decay in the money in it, the buying power, the real buying power, the dollar, not the dollar index that's measuring paper versus paper, but the dollar quantity almost doubles every decade. 90% increase in the quantity of M2, Well, if you factored that in, silver would probably be $200 now just to match those highs in real dollar terms. Wouldn't be exceeding them, it'd only be matching them in real dollar terms. So all kinds of things point to the acceleration phase going dynamic into a new reality. And the problem with getting over 50 recently is we surged from a low under 30 in April, okay? Started to come back up in May, and in June got back up to 34 plus, had 2 prior highs at 35, May last year, March of this year. So in June of this year, came back up to 34, headed toward those highs, and momentum said you're going to break out and you're going to explode. Is significantly different than what you've been doing instead of incremental. Well, sure enough, you went from, what, $35 to 53 in, what, a handful of months? I think it deserves a correction. Plus, when you took out the 50 high, what happened? Every idiot investor out there who thought the 2 highs at 50 were meaningful, again, nominally they are, but in real terms, they're meaningless. Real dollar terms. They got sucked in to buy it finally. And so you had latecomers come in at 52, 53, and they bagged them. Good. Should have been bagged. They should have been buying silver in the 30s or the 40s or the 20s even. And when they bought high, it created a vulnerable group of people. And so that's a logical place to have finally a correction that you could call a correction. You break that spread out, silver versus gold, and add to the gold stock market spread breakouts, which have already occurred, just waiting on the S&P now for that factor, and in tonal nature of the markets, something more like what occurred 79 to 80. And by the way, when we get there to those levels, oh sure, you get a sharp correction maybe, but you're in a new reality. You're not going 150, 200 and come back to 50, okay? You're going to live in a new reality up there. You know, maybe it's between 150 and 250, I don't know, but it's the main focus right now is that surge, because it should be very dynamic and a place to be. A place to be you've probably not been in your entire investment lifetime. So game is on, but we're watching those 2 metrics, gold S&P, silver gold.
Michaeloliver explains that traditional technical indicators, such as the RSI, become irrelevant when silver enters an actual breakout phase. In past cycles, overbought readings stayed elevated for months while prices exploded higher, a signal not to sell but to buy strength. He highlights that silver has been trapped in the same price reality for 50 years, unlike copper or lead, which have already quadrupled since their long periods of consolidation ended. Now, silver's fundamentals are powerful. 5 consecutive years of supply deficits, relentless industrial demand from solar and AI technologies, and minimal new mine output. The breakout above $50 triggered a wave of late buying, creating a short-term correction. But that's only preparation for a larger acceleration phase. Once silver establishes itself above $50 decisively, Oliver believes it will enter a new reality, potentially between $150 and $250. Let's get into the interview.
Why is gold going up? Dan, it starts to catch on to the story and understand what we just discussed. To move that into silver is a little more difficult. The reason being is that most people understand gold is money, or they have some association with gold. But very few people, unless they're my age or older, really think of silver as even having a monetary aspect. And it hasn't in a lot of ways. I mean, I have many in my peer group that say, well, silver is just an industrial. It's not, you can't call it. I differ with them. But my point is this, it is both an industrial commodity but there is a point that will take place in my studied view where the monetary aspect of silver becomes the most important part of silver. And that's because the depreciation of the currency is so great that people will buy anything and everything that they can instead of holding on to their currency, as I said earlier. And they'll move into a hard asset. So people that have wealth will buy gold. People that don't have a lot of wealth will buy silver. And there's a lot more people that only have a few thousand, a few hundred to buy or purchase hard currency with or hard metal with than have the ability to buy, $100,000 worth of gold. So I think you will see more and more people buying silver for that monetary asset. And that's when it moves away from its base case, where as an industrial commodity, it sells for the cost of production or slightly more. It leaves that part of the story behind. Not that part goes away. It's just all markets move at the margin. People want it for security, safety. We think about what is the amount of demand for money, and the amount of demand for money is actually infinite. The reason it's infinite is people depend on money or currency now, but money really, in order to survive. I mean, there aren't many communities outside of, Aborigines, even the Amish use some. So when you think you need it and you must have it, which we all more or less believe, but what you're holding is a false representation, something of value, and you start moving that 1 or 2%, or even 3 or 4%, it could get that high, into a market as small as the silver market. Price is indeterminate. I mean, it really is, because there's so little silver relative to the potential demand of infinity that people that wake up and say, oh my goodness, I'm going to buy 2 jars of peanut butter, but I got my life saving is $12,000. I can buy, 3 gold coins, or I can buy this much silver. So I think the gold silver ratio will continue to come down, meaning silver's favor. We'll go from like 85 to 70. I'm looking at 70 as kind of a turning point, and then down to 60, perhaps 30, and maybe even to the historic classic monetary ratio of 15 or 16 to 1. And if that happens, the silver relative to gold will be like a fourfold increase relative to gold. In other words, it'll perform much. And I do believe that will happen, but I don't know. So in that case, I think you should make sure you have both gold for wealth preservation, silver for wealth preservation, but also that beta, that high volatility that may take silver far higher, because we could and will probably see silver used as a means of transaction before the new system reset, or perhaps even after, where people are willing to deal in silver coins or bars for goods and service, be it renting an apartment or maybe an automobile or perhaps even real estate. I don't rule that out. I think, in fact, you might see that more and more as the Great Reset starts coming toward us at a fast.
David Morgan explains that silver's transformation from an industrial metal to a true monetary asset is inevitable, driven not by speculation but by the collapse of confidence in fiat currency. Most people still instinctively view gold as a form of money, yet few today recall silver's historical role as a form of money. That will change once currency depreciation becomes undeniable. As purchasing power erodes, capital will rush into tangible assets, the wealthy turning to gold and the broader public seeking affordable protection in silver. Because the silver market is relatively small, even a slight shift in global capital allocation can cause prices to soar. Morgan sees the gold-silver ratio contracting from 85 to 70, then 60, signaling a fourfold outperformance over gold. Eventually, silver could even regain its status as a medium of exchange for tangible goods and services. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.